Hello and welcome to CAP STRAT this week. Today we'll be talking, like we usually do, Magnificent Seven, FOMC, but we'll even find a way to work a fable in there and talk through some short stories with some important lessons for us. But we'll start with equity returns. Mike, tough week within a tough month for equities. Large caps down over 3%.
We've been saying since the beginning of the year, the market is vulnerable to a pullback until the Fed actually starts cutting rates. And why? Because about 30% of the market is 7 stocks, and the expectations for those 7 stocks are extremely high, and everybody's on one side of the boat. Positioning in mega cap growth stocks is so extreme that if you were to break it down into, well, what's a quality stock today? What's a low volatility stock today? What's a growth stock today? All of those factors, they all say the same thing. They all say mega cap growth. So what does that vulnerability look like? It looks like on a Friday, for no apparent reason, NVIDIA is down 10%. Of course, we would say there is a reason. We've laid out this narrative as to why that could happen all year long.
Yeah, but that
there was
specific day.
On that specific day, there doesn't seem to be a smoking gun, right? Heading into earnings.
And that's a lot of wealth lost, 10% of NVIDIA, right?
Right. So now, large growth is down 6%, small caps down 8%, large caps, the S&P 500 down 5.4%, so halfway towards a technical correction.
Yeah. Yeah, and let's just look at some relative numbers here. On the downside for the week, large value holding up much better than large growth and putting us in this position where year to date, large value is within 1% of large growth.
Who'd have thunk it?
Yeah, that's pretty incredible. So let's dive into that a little bit more. Here we're looking at similar areas of the market, but zoning in a little bit more. FTSE high dividend yield is our purple line here. The Magnificent Seven that you mentioned earlier in green. The Tortoise and the Hare, right? And if you're intimately familiar with the details of the Tortoise and the Hare story, please, forgive us here. Show us a little bit of grace. We've adapted it. I like to call it slow and steady wins the race.
Okay.
But Mike, fill us in on what's happening on this chart.
Since the beginning of 2022, shortly thereafter, the Fed started hiking rates and carried off the second fastest rate hiking cycle in history. You've had these two areas of the market that have sort of been opposing each other. One is purple, high dividend yielding stocks, slow and steady, the tortoise, if you will. And then in green, of course, the Magnificent Seven. And we all know in 2022, the Magnificent Seven were not magnificent. But from March through July of 2023, they made a ton of money, peak AI boom. And then since then, they've been off to the races. Since November 1st of last year, other areas of the market have been keeping pace. But Magnificent Seven have still been the winners. But then going back to what we've been saying all year, these are good companies that can become bad stocks if they get too expensive relative to expectations, relative to alternatives like cash, like high dividend yielding stocks. And, this is probably the biggest sign of that we've had since last summer, since last July. Last week, over the last, say, 5 trading days or so, the Magnificent Seven have been one of the worst performing areas of the market. And a lot of them aren't even magnificent anymore. Tesla, for example, is at risk of being dropped from the Magnificent Seven. The only thing that's saving it is Magnificent Six isn't a Western film.
Not the same ring to it,
It doesn't. So you need it in there. But on Friday in particular, you saw pretty much every other area of the equity market up, but the Magnificent Seven down. And the spread there, Magnificent Seven were down almost 4%. A basket of global high dividend yielding stocks up over 1%.
Yeah.
I mean, that's a huge delta in a day. So perhaps the Hare took a break late in the race.
There it is.
Yeah.
Yeah. So we've talked about how this rotation could be coming and the catalyst would likely be Fed cuts.
Yeah.
So are we ready to call this the rotation yet?
No, we are not, because the catalyst isn't there, and the rotation would be most likely it could be even faster than this and small caps would participate better,
Sure.
in our view. And that would come with rate cuts. This is just going to what we've been saying all year,
Yep.
that the market is vulnerable to a pullback because of how dominant those Magnificent Seven have been, how everybody's on one side of the boat.
Gotcha.
So big week for earnings for the Magnificent Seven. So hopefully they can right the ship here.
Yeah. And speaking of things we've been saying all year or most of the year so far, interest rates continue to rise, right? You see, we've got a lot of red on this fixed income board. Treasury's down 3% broadly year to date. You combine these rates rising with the recent weakness in equities, and it starts to feel a little bit like last summer when we were in that no landing scenario. Mm-hmm. What do you think about that?
Yeah, the bond yields rising to this level, we've talked about how they start to have a negative impact on equities, but there are more effects, right? There are more pass-through effects that, by and large, are disinflationary. They help the Fed in their inflationary fight. So to explain, one, you have mortgage rates. Mortgage rates are back up above 7. What does that do? Because we had long-term Treasury yields rise, mortgage rates are back up around 7. We know what that does. It freezes the housing market. It doesn't make housing prices go down, but it keeps a lid on them, which is all the Fed really needs to pull off. If housing prices stay where they're at for a year, then shelter inflation over the next year would be roughly 0. That'd be great.
Yep.
Right? So it puts a lid there. The other thing that it does is it creates this narrative globally where, all right, the U.S. economy is so exceptional, but is still dealing with this inflation problem, that short-term interest rates are going to be higher for longer there than, for example, in Europe. And so the dollar gets stronger. People say, I want those attractive short-term interest rates and bond yields in the U.S. So I want those. How do I get those? Well, I have to own dollars. So people buy the dollar. So the dollar gets stronger. What does that do? Everything we import is now cheaper. We saw this last summer as well. You had a big period of, all right, no interest rate cuts, higher for longer.
Yep.
Dollar gets stronger. All of a sudden, everything we're importing from China is cheaper. Goods deflation. And that created that narrative last fall, whereas, hey, inflation is coming down. It's sustainable, right?
Right.
So that's a disinflationary impact. And then also credit spreads get wider. So there are a number of different impacts here that all help the Fed in their inflation fight.
Yeah. And you referenced, some core inflationary measures, which is obviously what the Fed focuses on, but, headline level as well, wanting to check in on energy prices, right? Mm-hmm. Down 3% over the past week. Primary driver, in our opinion, there being, backing away from the brink of direct war in the Middle East. But that, if energy prices were to continue to fall, that would also have a disinflationary effect on the headline level.
Absolutely.
As well, right? Yep. And speaking of headline inflation, let's take a look at break-even inflation rates since early 2022 over various time horizons. So break-even inflation rate, this is not something that we're creating or making up, certainly. This is simply the difference between the nominal yield for a treasury and the yield on tips, right? So the difference there is going to be the market's expectation of inflation. And what we're looking at is that inflation expectation over 1, 2, and 5 years looking forward. And you can see as we sit here today, they're all kind of in the same ballpark, but that was certainly not the case even last week. Mm-hmm. So what's here?
The biggest one is these expectations are based on headline CPI, as you said. Food and energy is baked into there. If you're managing a portfolio and you're trying to hedge against the risk of direct war in the Middle East, there are a few things you can do. One is you can buy oil, or you can buy tips, because you think, hey, if that happens, then oil prices are just going to be higher, and that's going to be very inflationary. So if we get any sign that we're sort of moving off the brink of direct war, or the probability of that event falls, then shorter term break-even inflation rates will fall. And that, in our view, is a big reason why that happened last week. And then all these other things we talked about, the no landing. We think we're firmly back in a no landing type scenario. That the tightening of financial conditions caused by that, the strength of the dollar, higher mortgage rates, wider credit spreads, weakness in the equity market. All of those things, if you let them go on long enough, are disinflationary.
Yep.
They bring inflation down. And so now you have over these different time periods, all of them coalescing, the bond market coalescing around 2.5% expectation for break-even inflation, headline CPI. Said in different terms, headline CPI over that time period. And you say 2.5, well, that's above 2. Well, headline CPI over the long term, on average, runs at 2.5. And over that same time period, over the long term, on average, core PCE, the Fed's preferred inflation gauge, runs at 2. So all of these saying 2.5,
Yep.
that's now the bond market saying pretty quickly, all right, Fed, you're going to be good.
Yeah.
You're probably going to pull off 2% core PCE, which, once again, we know seems far-fetched because of the narrative right now in the market.
Yeah.
That inflation is running away. But like we said last week, we have every expectation when we get to that July Fed meeting, core PCE is going to be in cut territory. It's going to be a yellow light, if not a green light, for the Fed to begin cutting.
Yeah. And we got some constructive, tough love comments on our video last week around this idea of the Fed still, maybe being able to pull it off and cut. But as you're describing, right, you think about this no landing environment that we might be in already. And to your point, if you let these hang on long enough, they'll be disinflationary, give them the potential green light for a cut. That's good case scenario.
Yeah.
The other scenario is you let these things go on for too long, and then it's you need to cut.
Yep.
But either way, the answer is more likely to cut.
Yep.
In this no landing scenario. We talked about how these numbers relate to core inflation prices. Anything you want to talk about in terms of our inflation projections for 24?
So we get core PCE this week.
Yep.
Generally, that one's the least likely to surprise in either direction. So if that comes in line with expectations, it'll be at 2.7% year over year, slightly down from February core PCE. So you view that as progress.
Yeah, absolutely. Take that. On the economic growth front, we still continue to see expectations coming down slightly. Anything notable on the economic growth projections?
We're getting Q1 economic growth data, the advance estimate, coming up soon as well. That, by all accounts, is very solid.
Yeah.
So,
awesome. And then liquidity. Last week we took the Israel-Iran conflict through the investment framework, but here specifically talking about the Fed and potential for cuts, right? If cuts dwindle and or get delayed, this liquidity pop that we've been expecting in the second half of the year will either be diminished or potentially eliminated.
Yep.
Right?
And this forecast is reflective of our shift from thinking the first cut would be in June to now the first cut being in July.
Yep.
Still with 3 cuts this year.
Still 3 total.
Still with tapering the pace of the balance sheet runoff, but that's starting in June. Because notably in the FOMC minutes from the most recent meeting, the March meeting, there was still more discussion about reducing the pace at which the Fed is shrinking their balance sheet. So we still have every expectation that is moving on a different timeline than interest rate cuts. And so it could happen sooner rather than later. But you take all those things into account, all of the adjustments to our forecast, and you still have a pretty benign liquidity environment. It's lower than it was before it topped out at a little over 3% growth in our forecast horizon. Now we're down to 2.65. So you can see that should be somewhat supportive of risk assets,
Yep.
but also is less likely to create persistent inflation. If money supply growth is, why did the Fed do this?
Yeah.
To defeat inflation, right?
Yep.
So anytime this line moves down or our forecast moves down, that means a big spike in inflation becomes slightly less likely.
And then we'll wrap up with the recession signal. The yield curve signal remains the only active signal, but we are starting to see some yellow here in the equity market stress, heavy truck sales. And, this is what we were talking about, where if you're into the no landing, you might start to see some yellow pop up here. That would be disinflationary, would allow the Fed to cut. Mm-hmm. But if you start to see some more red and a greater number of yellows, and this starts to trigger, then it becomes a need to cut type of situation.
Yep. And the narrative totally shifts, right?
Yeah. Absolutely.